indexed universal life versus variable universal life. If you're considering using universal life as a means for growing your money, using it in the future, which one should you go with? We're going to go over the pros and cons of both the IUL and the VUL, and then from there kind of talk about, based on what you're actually looking for, which one might be better. Hint, it's not a cookie cutter answer. It really depends on what your goals are. Quick disclaimer, we are going to assume that both of these policies are structured and funded properly. That means they're being maximum funded for the most amount of premium for the least amount of insurance so that they're able to leverage the cash growth tax-free. With that being said, when an IUL or a VUL is structured properly and maximum funded, both of them are going to give you cash value, they're both going to give you death benefit, and they're both going to give you flexible premiums. So even with an IUL, if you are planning to fund it over 5 years, if something goes wrong, you got to take longer to fund that, you can do that. Premiums are flexible. As long as you try your best to get the full guideline single premium in there, they're both going to give those 3 things. The main differences between the two of them are pretty clear, and I think even though it's not a cookie cutter answer for which one is correct, based on your goals, it generally is pretty obvious. So first, with the IUL, you're going to have downside protection. That's generally why people are looking into IUL in the first place, is they want to opt out of market volatility. They don't want to deal with the market going up and down anymore. So we have the downside protection, meaning when the market does go down, we are not going to lose any money due to that. The only money that might be lost is the minimal fees from that year. With the VUL, however, our money is actually still being invested into the market. So in this case, if that's what you were looking for, is getting out away from market volatility, this wouldn't make so much sense just to get a VUL for the tax-free growth, because you're still going to be in mutual funds. Of course, you're not going to have the downside protection and you could still lose. So if your goal was downside protection, of course, the VUL wouldn't make much sense. But if your goal was just to have the tax-free growth, but you're still fine with the volatility, VUL could be a viable option. The VUL also is always going to have dividends. The IUL is not. And then of course, because our money is actually in the market instead of linked to the market like with an IUL, the upside potential is going to be much higher on the VUL. But of course, that comes with its much higher risk. We don't have any downside protection, so we could also lose lots of our money. With the IUL, our upside potential is generally going to be capped for the downside protection. However, there still are multiple indexes to where if you are wanting to still have a chance to participate in higher upside potential within the IUL that are uncapped or have higher participation rates. So those are always an option. So in general, the main differences are going to be the risk tolerance of the two and then the dividends on the VUL side. When most people are getting closer to retirement, so if you are 50, 60 or someone who's getting ready to retire and can't necessarily afford the market to have a bad downturn, that's where generally I think the IUL is going to make a lot more sense, is because we've built up our money. Now we want to protect it so that we can retire and focus on what actually matters to us, not spending time worrying about if the market is going to crash. Now, if you are someone who is younger, someone who wants to be more active in your policy, who's fine with taking on risk and still wants the higher upside, they aren't necessarily afraid of losing a large chunk of their money due to a stock market crash, well then a VUL might make sense, but it still just depends on how much money you want to be able to depend on to be there if you needed it for any sort of reason. Me personally, even though I am younger and can take on more risk, as an entrepreneur who needs access to my funds and wants to be able to pounce on an opportunity, I personally only have money into an IUL for that reason. But it really just depends person to person. Hopefully this was helpful. If you have any questions about the differences between the two, feel free to ask below. And I do ask you to subscribe and make videos like this 5 times a week. I will see you in the next video. Bye-bye.